All right. Hello, everyone, and thank you for continuing to join us throughout the day here at the Lytham Partners Fall 2024 Investor Conference. My name is Robert Blum, Managing Partner of Lytham Partners. And for our, I guess we'll call our lunch keynote panel here, I'm pleased to be joined by three individuals who have been involved in the micro and small cap markets for a number of years now. Two of them are portfolio managers at leading small cap focused funds, while the other is a research analyst who I've known for probably more than 20 years now, having covered a wide variety of micro and small cap names. And I'm excited to have each of them join us to discuss some of the recent trends in the micro and small cap markets and maybe how they're adjusting their approach given some of these recent trends. So, let's sort of dive right in with some introductions. Chris, why don't you begin?
Well, my name is Chris Abbott. I'm the founder and CIO of 1035 Capital. Been running it since 2019, which was a terrible year to start a small cap investment fund because, as we all know, COVID came around the corner not too long later. But it's been really a great way to reinvent myself and reinvigorate the process that I used. It led me to change a lot of things in my process, and I know we're going to talk about that later, so I'll leave it for that. I'll leave it there.
Perfect. Dave?
Yeah, hi, Dave Achey at the Horton Fund, co-founder and CFO. We launched in 2013, so we got a couple of years before the pandemic hit, but happy to be here. And generally, we make private equity style investments in micro-cap public companies, so we'll be talking from kind of more the smaller end of small cap, focusing on those $500 million market cap companies and below.
Perfect. Sounds good. And Barry?
Hey, good afternoon. So my name is Barry Sine, and unlike the other two panelists, I'm a sell-side equity research analyst, and I have been for over 25 years. And, I've had the pleasure of interacting with Lytham, covering a number of their represented companies over the years. I guess one of the things that sets me apart a little bit, I have earned over the course of my career both the CFA charter for fundamental analysis. So I look at the traditional fundamentals, but also the CMT charter. So I look heavily at the technicals. And I'm going to weave that into the conversation today because I think as we see more quantitative trading, the technicals become more important.
All right, great. Well, thank you again to all three of you for joining us here this afternoon, I guess, almost now. Let's sort of dive in. Microcap sort of markets up 5%, I think, for the year, maybe a little over. Nearly all those gains have happened since I think it's mid-August, right? I mean, we've had some fluctuations, but I think we're almost break even at August. Still down 20% from the 2021 highs. Obviously, needless to say, it's been a difficult micro and small cap environment. Going back to obviously, Chris, what you just mentioned, starting off with COVID here. Let's talk about some of those sort of key adjustments or refinements to how you've managed your strategies and your thoughts over the last couple of years. And Chris, why don't you start?
Well, as I alluded to, I've kind of made two big changes. The first one is, and I don't necessarily recommend this to other portfolio managers, but I've decided to really concentrate on the stocks that I have high conviction in the intermediate path. Hard to say what happens day to day. We're all in small and micro cap land, so hard to predict next day. But if I've got high conviction for the intermediate path, I think over time it'll work out well. But that's led to a lot of concentration, a high tracking error, and a lot of volatility. So probably not something to replicate for a lot of people. The other thing I've done a lot of, and I do recommend this for a lot of people, is I've spent hundreds, maybe thousands of hours really automating my process since I started my own company after coming out of 10 years on the buy side. And really, at this point, I've coded a lot of my early screening, early fundamental analysis, risk management, and sell process. And it just takes so much of the emotion out of the selling and so much of the, let's say, agony out of going through the financials. So it's just really, I think, been a helpful addition to my process. And with the advent of AI and large language models, now it's never been easier to learn how to code. And the possibilities really are endless. So I just really think that's one of the remaining edges left for fundamental guys, let's say CFA types, to take that really solid understanding of how to run a business and then automate it so you can replicate yourself in many more situations. And like I say, with AI, now's the time to learn it.
Yep. Dave, maybe talk about some of the change that, I mean, again, you guys have been around for, a decade plus now. Talk about maybe some of what you looked at in terms of some of the fundamental analysis that maybe you were doing, or other types of analysis you were doing a few years ago versus what you're doing today? Have things changed significantly, or is it pretty tried and true sort of methodology that you guys are applying?
Yeah, I think I need to sidebar with Chris to learn how to maybe automate some of our work, because I'd love to figure out how to take out some of the labor intensity that private equity style due diligence involves. I think for the past 11 years, we are borrowing from the private equity playbook and applying it to public companies, which means we do a ton of fundamental due diligence. We spend a lot of time with our management teams. We follow companies for a long time before we invest. We're pretty methodical in what we do, which means sometimes we miss things, but we prefer the high analytics, patient methodology to kind of putting on a quick trade. And borrowing from that private equity playbook, I think during the pandemic, the 2020 to 2022, we really went heads down on our portfolio. We didn't make a lot of investments. We're really trying to understand, kind of the sift through the rubble of 2020, and then the run up in 2020, late 2020, 2021. We sold a couple positions when the S&P hit 45 times trailing. But a lot of that time was just understanding supply chain dynamics, what's the new normal, and try and help our companies as best possible think through their capital plan during that time. I think 2023 was really the turning point where we returned to maybe a more of a normal investing cadence, which felt great. Started seeing value again in the market, started feeling like we understood the fundamental dynamics. Capital raising at that time increased by about 30%, 22 to 23. So right now we're seeing more deals than we ever have in a long time. And we're starting to see more investable assets than we have in a while. So we've made 5 new investments over the past year. 3 of them were direct investments in companies. That's a lot for us, for a portfolio that's 10 to 15 investments at any one time. So we're similar to Chris in that we're pretty concentrated. But I think that's the big change for us, is that we're kind of returning to a normal investment cadence now, and it's feeling like we can, kind of get out from under the existing portfolio and think about other things.
Yep. No, all right, that's helpful. And I want to come back to the financing topic here in just a minute. Barry, you're coming at it from a little bit different perspective here. But again, you've been a sell side analyst for 25 years. I was looking at some of your accolades, sort of top 5%, won a number of Wall Street Journal awards and such for your sort of stock picking ability. As you look at what you were doing 20 years ago versus kind of the way that you're analyzing stocks here today, what sort of changes have you had to make in terms of assumptions, whether it be balance sheets or otherwise?
Well, I mean, let me start with something that hasn't changed. A good fundamental company, and the fundamentals haven't changed. You start with revenue growth, with profitability, with a management team that has shown by their actions to care about shareholders. In the long run, those companies will outperform. What has changed, however, is the long run has become less certain. What is the long run? When will that happen? Because we've seen so many regulatory changes that have made it more difficult to be a public company. They're increasing the penalties on accountants now to penalize them for company fraud. And we've seen changes in the economics. So we've seen fewer sell-side analysts covering small caps. We've seen fewer active funds managing small cap or even especially microcap funds, and we've seen growth in quantitative trading. Overall, I've read that the market overall volume is over half quantitative funds, and I think that's even greater on the small cap and microcap side. So that's where my background in technical analysis comes in, because whether you're trading quantitatively or fundamentally, your activity still shows up in the charts. And the quant models they call it artificial intelligence, but they can be quite dumb at times. So for example, if a company's made an acquisition, they're going to, and that's not factored into the numbers, they're going to beat the numbers. The quant models don't know it was due to an acquisition. Likewise with a divestiture. So there's a number of those opportunities that we have to look through the fundamentals, understand what we can learn from the charts and from the price action, and incorporate all of that in as the markets have changed.
All right, that's a good point. Let's build on that here in a moment. Let interest rates, right? Sort of a topic here over the last couple of weeks. Maybe to what extent do you guys think that these markets have been, interest rate driven? I think the double-edged sword here, at least the conversations I have with so many sort of investors, especially on the small cap side, is, interest rates have impacted them, right? Cost of capital increases, borrowing costs, the equity raises have been difficult. We'll chat about that in just a moment here. The flip side, now that we have rates, sort of coming down, is that I think it's, sort of been a prelude to a recession. I think at least over the last 4 out of 4 or 5 out of 5, we'll see what happens here, right? Chris, maybe starting off again, to what extent do you think that the markets have been, especially small microcap, have been impacted by the rates? And, with any sort of movement, do you see this as a positive, or is it, hey, looming possible recession, we need to be careful, looking at it from that perspective?
Well, I guess I would say one of my absolute favorite things about micro and small cap is I love that there's thousands of companies and most of them are pretty razor focused on one or two things. And a handful of them are razor focused on what would benefit from a recession. So I think the beauty of small and micro cap is if you're creative enough, everything is up. So it's not good. I don't want to see a recession happen. Certainly not my point. I do think that the struggles of the last few years have certainly largely been dominated around interest rates and capital costs and ability to raise capital. But, I guess as a bottoms up guy, and David, I'll mention really quickly, you notice all my automation is around the front and the back end of the process. I'm a big dig into the management team, understand the business guy, and that middle part, I just got to figure out a way to automate that. That'd be great. Haven't figured it out yet. But that being said, I think interest rates have caused a headwind, but I guess I expect a management team to be able to manage through a challenging environment. Part of that is, sometimes cost of capital goes up. It's not the first time cost of capital has ever gone up. It's the first time in a while. I really think that a lot of management teams use that as an excuse for poor execution. And to Barry's point earlier, execution is everything, right? It's about actually doing what you said you're going to do, drive those cash flows, drive those earnings, and then your stock price goes up. And you know what? The management teams that executed in the last few years, they did get rewarded. Maybe it's not as much as they would have in a better environment, but they still got rewarded. So it really comes down to execution. And, maybe I'm being harsh on management teams because things change and it can be tough. But, I do think that it was a headwind. The good and the great management teams were able to manage through it.
Yeah. Dave, building on that, again, pretty concentrated portfolio. You've initiated a few new positions here in the last year, I think you mentioned. If rates are lower, what impact is that having in terms of your analysis? Are you looking at companies that may have more debt? Are you willing to take on companies that are maybe approaching break-even versus profitable? What impact, if any, has it done to your analysis?
Yeah, I think our analysis has generally stayed the same, but I think we are seeing more opportunities. To piggyback off what Chris said, there's in our space, the sub $500 million market cap space, there's 8,000 companies out there to sift through, and more than half of them are unprofitable. So you have the situation where, of course, they are going to be rate sensitive, at least from a trading standpoint, because there's an inevitability that most of them are going to have to raise capital at some point, or at least tap the capital markets at some point. So we are seeing an uptick in the willingness to have a conversation and the interest in raising capital again. I don't think we're going back to the SPAC craze of the 2020s. I think investors are being more selective, which means that some of these companies aren't going to get funded. And so I think that's the challenge with if you wanted to try and index or passively invest in this space. You're going to see a lot of companies that go belly up because they just weren't able to attract the capital or prove out that they are executing. But there are going to be some real winners there. And so it's a great opportunity for active managers, stock selectors like ourselves.
Yeah. All right, Barry, anything to add there?
Yeah, so on the interest rate environment, I'm a little concerned about the Fed's recent rate cut because we only got inflation down to 2.5%, and their target has always been 2%. So, will that be a little premature? Maybe they have to raise rates again. But putting all that aside, I'd largely agree with the other panelists in that you have to look at management teams that can execute regardless of what the interest rate environment is. There are exceptions, obviously. There are companies that are highly interest rate sensitive, community banks, for example. And then if we tie in our discussion of interest rates in the economy, we have to look at, possibility of a recession, which I personally don't think we're going to have happen. I think the economy is still strong enough that we can get through that. And then I know, later on you'll bring up, the election. There are companies on the margin that can benefit in any environment. With 8,000 microcaps out there, there's companies that can benefit from a recession. There's companies that can benefit from high interest rates, low interest rates, and some of that can be done screened out quantitatively. And then there are other companies that may not be as obvious that can benefit from some of these factors. I cover, for example, a company that processes payments for payday lending, and that'll go up if there's a recession. And they don't make the loans, but they do the processing. So there are ways to make money in any market. But again, I think the key is not to make a macroeconomic bet, because a lot of the time those macroeconomic bets are not correct, but to look for companies that can execute in any environment.
Yep. All right, good point.
Piggyback off of that, I think this is the first time in 25 years where the Fed has cut 50 basis points while also making positive comments about the state of the economy. So you have this unprecedented period right now where we're just trying to sift through things. So to Barry's point, making a macro bet, maybe not the right time, but you do want to be kind of looking for, some defensive names that can still succeed, in almost any economic environment.
Yep. All right. No, that's another good point there. Let's sort of talk about maybe sectors, industries, whether it be because of interest rates or just kind of the environment that we're in here. Dave, I'll give you sort of the first shot on this. What changes have you looked at? Are there certain themes that you're looking at? And maybe on the flip side, is there anything that you're sort of just saying, look, we've moved away from this, right? I mean, if it's something that was never part of your general, sort of industry focus, we can put those aside. But is there something that you were looking at 3 years ago that today just sort of not comfortable with? So maybe start off there.
Yeah, I think, on the stuff that we've moved away from, I've made plenty of mistakes in 11 years in doing this. I think we've generally moved away from consumer discretionary names, in particular retail and retail exposed companies, if they're in the retail supply chain. It's just really hard to figure out that space, I think. And so we've evolved a little bit more to prioritizing more defensive, IP protected types of companies, or service providers to those types of companies. So our two themes recently have been kind of disruptive healthcare and what we're calling AI enablement. So not necessarily the AI side of things, not necessarily investing in the bleeding edge LLM models or software companies, but technology integrators or component providers that would stand to benefit from the proliferation of AI, in particular on the government side, just accepting that the government's probably going to be the early adopter and where there's big money. On the healthcare side, an improving capital environment, lower interest rates, has really helped the R&D spend in pharma, biopharma. So we've had some success with the pharma services companies, CROs, CDMOs, research services. Those investments have worked out pretty well. And we see that being a pretty favorable environment in 2025 as well. While layering on top of that, I would expect some more M&A activity within pharma, biopharma, and services.
Okay. Chris?
Well, I guess my my big sector bet has been a function of the companies I find interesting more than I like this sector per se. Right now, I'm quite overweight materials, interestingly enough. Not necessarily because I think materials are the greatest thing in the world, but the companies that I like, which are really bottoms up types of companies, where I see fundamental massive dislocations in value. And to David's point, I think the market is pretty ripe with really interesting opportunities right now, especially in small and micro. So I'm really overweight materials, but it's more of a function of kind of the names I'm involved in rather than per se my intention. Then the other thing that's kind of fallen out is, I think last time we were on this, I talked about being a bit of a uranium bull, especially around the conversion of it. And now, since then, spot prices pulled back, all the uranium miners pulled back pretty aggressively, and I'm seeing a lot of attractive opportunities there. And you just kind of look at the demand situation. You just saw a massive deal with Microsoft and Constellation to reopen 3 Mile Island, of all things. I mean, like, that's a pretty heavy name in a lot of people's minds to reopen that for, like, I think it's a 20-year deal. That tells you that nuclear will have a place in the future, and we're already short on uranium. So, and then we're even shorter on uranium conversion, hence my interest in that portion of it. But I think that's coming. As a result, I'm pretty overweight energy, not necessarily overweight oil and gas like traditional energy, but around uranium. Like David, I'm staying away from consumer discretionary. I guess contrary to Barry, I think we've been in sort of a rolling recession really since COVID. I don't think the economy has ever gotten back on its feet. It's never been firing on all cylinders. And I think right now we're rolling towards the consumer feeling it. As a result, I frankly am staying away from most consumer discretionary things. They're like everything, there's opportunities. I like the kind of weird things. So there's always those types of opportunities in consumer as well. But generally speaking, I've been moving away from consumer discretionary. I just think that's a weakening part of the market right now.
Yeah. Barry, you're agnostic, I think, with a lot of the names that you're covering there, right? When you're sort of looking at different sectors and maybe even ones that you were following years ago or looking at today, anything sort of coming sort of, into focus more a little, or that you're focusing on more, and maybe some that you moved away from as well?
So, again, I'm not focused as much on individual sectors, and I don't have, 2 or 3 sectors to throw out to tell you that I really like. But what I do like to look at are what are some macro themes out there. The internet economy, is still growing. There's still new applications, entertainment, and so on that are still largely moving to the internet. And then, there's providers, marketing services providers. One company I cover does white label music services. So a Costco can compete with a Amazon, for music, for example. Other trends, digital electronic payments, companies that enable, those things. Cybersecurity, companies that enable cybersecurity, and the government is a great customer for cybersecurity, in healthcare, automation of healthcare. Telemedicine is a big trend in impacting artificial intelligence, inserting that into telemedicine, improving patient outcomes. So I like to look at macroeconomic themes and then find companies, irrespective of sector, that are applying those macro themes, those technologies, to outperform their peers and to grow.
All right, good. Maybe this one would probably be more appropriate for Dave and Chris here in terms of the management here. But as you've sort of looked at your portfolios here over the last couple of years, and then sort of gearing up for the future here, when you've looked at growth versus profitability and sort of what equity raises have done, sort of the cost, obviously very expensive in terms of discounts, warrant coverages. When you are speaking, and I know each of you sort of speak to management teams on a regular basis. I'm sure you're giving some thoughts and opinions. How are you advising them to manage the growth versus profitability right now? And in terms of some of the red flags that might be out there and with some of these capital raises that are just something that, hey, it's a no-go for me going forward here. So maybe Chris, growth versus profitability and your advice to companies here on trying to manage the two of those in the current capital environment.
I mean, clearly everyone cares about cash flow generation right now. So if you're not profitable and you're not generating cash flow, you better focus on that ASAP. I mean, in some in some cases that's just not possible. So you're an early stage biotech, there's nothing you can do to focus on cash flow until you get to approval, right? So, I mean, in some cases that's just not possible, but if it's possible, you're close to cash flow positive, that should be everything you're doing right now. If you're a management team, in general, I prefer to invest in cash flow earnings positive companies. I'll make an exception to that if you've got a unique product and you're spending to grow that product, and you've got a viable path to go from spending to grow to becoming cash flow positive and profitable. I can get behind that. I find that those tend to be a lot of the biggest winners. Are You're kind of in that position between, is it going to work and is it not going to work? And as a result, there's uncertainty. And it's that uncertainty, to me, is where the opportunity is bred. So I can get on board with that. I prefer to see the profitability, but in this environment specifically, you got to get yourself to cash flow positive.
Yeah. Dave, you mentioned that you made a couple of direct investments. Have these been in sort of a structured format? Have these been sort of straight common deals? And how are you advising companies or talking? And I think even represented for your company or on the board of a few publicly traded companies, I believe, as well, right? So, how are you sort of looking at how they're balancing and the structures on which you might recommend these companies proceed in any sort of a capital raise?
Yeah, so we generally prefer to invest in profitable companies or companies with a clear path to profitability. And I think, being able to show that you have clear operating leverage to produce real earnings power over time is just crucial. We wouldn't invest in anything, especially an unprofitable company, if we didn't see that. So when we make a direct investment, we would prefer to be the last round of capital that this company ever needs, right? So that's kind of the goal of us getting involved. We don't want rainy day funds. We don't want, we call it whoosh funds. So you put money in and whoosh, it goes right back out the door to pay other obligations or pay out debt. That's not our type of investment. We don't want complicated capital structures. You got multiple layers of preferreds or converts or, a whole bunch of warrants of overhang. That's not really going to be our thing. So, we would either advise you to either clean it up or do one fell swoop, cleanup trade to fix all of that stuff. Otherwise, I think you're going to have kind of an overhang on your stock for a pretty long time. But our focus is high gross margin businesses, high earnings power potential, profitable or path to profit.
Yeah. All right. Let's transition here a moment. The election, we're about a month away here. Barry, maybe I'll give you the first shot at this one. To what extent do you think it will have any bearing on sort of the markets in general, and maybe sort of small caps specifically?
So I think the market will have a significant bearing, but not in either direction. I don't think it really matters as much who wins. It's just the tremendous uncertainty. Every poll that we're seeing is 49, 50, 50, and the market doesn't know. We have uncertainty. There are ways to invest regardless of which party wins the election. But on election day, or hopefully a few days later, we'll get that certainty that the market needs, and investors will be able to go out and make their bets and start investing again. And as I say, either way, there are companies that can prosper under a Harris type economy. There are companies that can prosper under a Trump type economy. But getting that uncertainty out of the way, I think, is the most important factor related to the election.
Now, Chris, you mentioned a couple of energy names and such. How, if anything, are you taking into account the election and how that might impact some of your investments based on either one of the current candidates?
Beauty of it is uranium is kind of in a nice sweet spot. It's enjoying a resurgence of love after years of hate. So, and that years of hate has really created a situation where supply and conversion capacity is not there. So that's the unique thing to uranium, I think. I agree on one level with what Barry's saying, that I don't think it really matters who wins the election per se. Short-term volatility aside, one of my favorite small cap research guys is Jim Fury Research. He just put out a really interesting analysis, just went back through time, and just said, hey, what happens to the small cap market if Republicans win? They sweep. If they don't, if it's split, etc. Democrats sweep, don't, etc. frankly, within any sort of standard deviation, it's the same. Okay, like within reason, it's the same, plus or minus a little bit. So on that level, I don't think it really matters. I guess on the other level, I'm a Canadian. I moved down here from Canada. I often get the question, would you move back to Canada? And I always think it's such a silly question. I didn't come here by accident. I came here because I prefer the American system. I'm a big fan of capitalism. Unfortunately, I watched socialism negatively impact Canada in a big way. Case in point, since I think it's like 2008, we went from one of the highest GDP per capita in the world to now we're like 30th. So we haven't grown in 10, 15 years. And during that time, we've been socialist. Yet the nominal GDP looks great. So my concern here is that one of the two major parties here is openly advocating for a system that will wreck this economy. Socialism and Marxism always wrecks economies. It's done it everywhere else. It'll do it here. I've seen it. It happened in Canada. It'll do it here as well. And maybe it takes longer. So I think you potentially have to throw historical precedent out the window in at least one of these cases. So my experience tells me hopefully we don't take the socialism route, and hopefully enough Americans realize that it's not a route to success at all. Whether you like the candidates or not, socialism isn't the answer.
Dave, anything to add on there?
Yeah, I think, well, from a market standpoint, I think stocks have done well under both Democrat and Republican presidents. If you look back at the data over time, I think we've seen some data, though, which might contradict what Chris was quoting, that the market seems to prefer a divided government in Congress and has tended to underperform when a single party takes control of the House and the Senate. So I think the down ballot races might be pretty important. And so we'll be watching that. But assuming there's a divided government, I think there's plenty of opportunity for small and micro cap to perform. I would focus.
I agree with you, David, just to be quick. Divided government is a slightly better performance, but it's not significant. So in my opinion, it's not significant, but perhaps you think differently. But yeah, I'll send you over the research too when we're done.
Great. I think regardless, I would focus on kind of the areas of economic agenda where, these candidates generally agree or the parties agree, strong domestic economy, energy independence, strong military, supply chain resilience, those sorts of things, I think we all agree on. And there's plenty of companies that would benefit from those sorts of initiatives. Focus on companies where revenue comes from domestic sources, not a lot of international or global exposure, strong supply chain dynamics, are you second source some of your products, make sure that there's not going to be any disruption there. And potentially where you benefit from continued government spending, depending on which party takes over, there's still going to be a lot of spending.
Yeah. Our audience here is probably going to be other investors like yourselves. It's probably going to be some public company executives as well. For the public company executives, what advice would you give them in terms of how they present their stories to the street, how they should be interacting with investors? What are some of the biggest sort of maybe snafus that you see in public company executives doing? And Dave, I'll give you the first one on this.
Sure. I could go on and on and on. We talk to our companies about investor relations and interaction with the street all the time. I think maybe I'll say three things. One, don't assume your shareholders are dumb. You're not going to be able to hide the ball. Be transparent, be open to feedback. In my opinion, you earn credibility by communicating your targets and the KPIs along the way. And you won't get punished for changing those targets as things evolve, so long as you have a cogent explanation for why. I think too many times, you put out a target and then something happens and you bury that and you don't acknowledge the fact that you used to have a target. So be honest and upfront with things. I'd say stay on top of good governance trends. I think there's too many microcaps that are behind the times on good governance. A lot of decades old classified boards, conflicts of interest, poor disclosure, plurality voting, everybody's going to majority voting. we don't want to have to write letters or make shareholder proposals, to our companies, but we will. And we have, but because we think it's in the best interest of shareholders and small cap, micro cap in general to improve governance. And then finally, this is just a little bit of my pet peeve is embrace the annual meeting. I think there's too many micro caps that view the shareholder meeting as a check the box. And prior to the pandemic, it was a place that you would have at your New York law firm where a couple of shareholders would come and then get a free sandwich. I think there's a lot more you can do with the annual meeting. You only really talk to your shareholders 4 or 5 times a year formally. Don't miss that opportunity to talk about your strategic plan, reinforce your long-term targets, and appreciate your shareholders for being there with you.
All right, Barry?
So I'll agree with everything Dave just said and just follow on, not just the shareholder meeting, but the quarterly communications. I think earnings calls are critical. Even if you don't get public questions, you can have your IR firm, do some of those. Snafus, don't get overly optimistic. I like to see companies giving guidance. Every company has their own internal forecasts. Share those. You can haircut them, but share those with investors. And then, very importantly, and I'm singing my own book here, is I think the importance of research. An analyst can write up a company in plain English. You're not allowed to do that in a 10K. You've got to fill the whole thing with risk factors. And then the other important thing about research is you get estimates out there on the major platforms, FactSet, Bloomberg, and again, going back to the importance of quantitative models, those quant models live and die on those forward-looking estimates. And if there's no estimates out there, it makes it very difficult for the quant models to trade the stock. So at least having one estimate out there and a consensus number is very important.
Yep. Chris?
I mean, I think that's great advice from both. I'd just kind of reiterate 2 pieces. One, take every opportunity you can to communicate to your stockholders. I mean, don't do it at the expense of running your business, but you really should be talking to these people. They are your partners. And the more, the better, the clearer the communication, the more transparent, all of that leads to a higher multiple. And then the second piece is, always, always, always under promise and over deliver. It's the one thing that you can do that's in your control that will always benefit yourself and your shareholders. Under promise, over deliver. I know we all get excited and we get ahead of our skis a little bit. Happens to me too, but you just got to rein it in as much as you can. If you think it's going to take a month, say it's going to take 2 months. Don't just haircut it a little bit. Give yourself plenty of room to be wrong. No one's going to be upset if you're wrong by being early, but they will be upset if you're wrong by being early.
Excellent advice on from all 3 of you. All right, wrap things up here. Make sure we can come back 2 years from now, look at this and see where we were right or where we were wrong. What's your outlook here? I just mentioned we're up 5% or so on the microcap indexes this last year, still down from 3 years ago. You guys put any time frame that you feel appropriate to, in terms of your outlook here. But if we look at the larger markets here within the small and the micro cap space over the next, again, year, 2 years, are we higher? Are we lower? Significantly higher? Chris, you get the first stab here.
Well, I mean, I've been in the camp that the conditions are right for a multi-year small cap run. We've got the widest spreads in valuation you've seen in decades. Finally, we're starting to see earnings growth start to pick up. And maybe I'll take a quick sidebar here. One of the things I do a lot of in my automation is I use it for a macroeconomic look, kind of top down, what's happening in the markets. So I guess I'll quickly do a little bit of boasting, I suppose. I have a Substack where I make a lot of this data available. It's called Unloved and Underfollowed. So broad market update every week, and then 4 to 8 stock articles a year. But I also have one called the Small Cap Report. It just focuses on small cap, and I put a lot of proprietary data out, make it available to investment. So feel free to check that out. But really, what I'm seeing is what I would look for conditions for multi-year run in small cap. They're all there. Low valuations, improving earnings, it's what you want to see. Those tell me, hey, we're moving. The problem is it's very difficult to say, hey, this is the inflection. Is it this week? Is it next week? Don't know. But I think interest rates have been a big headwind for small cap. Them coming down, that's as likely the trigger as anything else. I think that's possible. It's hard to say what it is that changes the regime, but I think we're getting there. And I think we have a nice small cap run coming. I'm going to kind of bring up one thing that Barry said about I am a little bit uncomfortable as well with interest rate cuts here. I think that might be a little bit premature. And I'm also starting to get a little bit concerned with what we're seeing out of China around stimulus. If they really start pressing the gas, commodity inflation's coming back, and then that makes further rate cuts a little less likely. And then perhaps pressures rate rises. So I would just kind of echo Barry's kind of concern there. I do think that's a realistic concern. Which is why I've been hiding in my stocks that I think, hey, love what you're doing fundamentally. I think 3-5 years down the road, this is going to be a big deal. No one knows about it today, but they're going to find out. And kind of irrespective of what happens around me, it should work.
Yep, I've heard your that comment from many that I've talked to you in the last couple of weeks. Dave, your outlook here.
Well, I'd have to echo a lot of things that Chris said. So I'm going to have to follow the Substack because it sounds like we're pretty aligned on some things. I think, there's a lot of arguments for this to be a great time for small cap. We talked about the interest rate environment. I think there's a lot of dry powder that's coming off the sidelines as well, looking for value. We haven't really talked about the catch-up trade with the Mag 7 large cap trade, which I think is still in process. And a rotation out of mega cap into small cap can have a big effect on small cap, just from a law of large dollars standpoint. So all of that kind of bodes well for small caps. Just to talk my own book as an active manager, though, I am concerned about passively investing in microcaps. Buying the index means you get exposure to all microcaps, good, bad, and otherwise. And I think there's going to be some that don't find the financing, aren't successful, and that's the beauty of why we're in microcap, to be able to sift through the wheat and separate the wheat from the chaff. But so we might not see as strong an index performance, but I think there's going to be a lot of really great opportunities to stock select within microcap.
That's a very good point to bring up between the market and the individual stock picking here. Barry, final thoughts?
Yeah, so I don't do formal macroeconomic work, but will give you some numbers to pin me down. A year from now, we'll be up at least 10% in microcap indices, however you measure that. Reason behind that, the fundamentals certainly support much higher valuations. I see a lot of companies that are not just fundamentally undervalued, but you even see companies trading below their cash values. I also see one of the topics we've talked about today is the markets are now focused on profitability. That wasn't always the case. Was it 5-10 years ago? The markets rewarded companies that were growth-based, and I still see companies today that are going through that transition and are in the ninth inning of getting to profitability. So I think you're going to see more companies that are making that transition that are profitable, and that's going to raise the indices overall. From a macro risk standpoint, again, we'll go back to what we've all talked about, is that interest rate environment. Was the Fed a little premature in cutting interest rates? Could we see an environment after the election where we see, another big spending bill? And if we see a lot of dollars coming out of Washington, that will drive inflation and that will cause the Fed to go back to a rate rise environment. So that would be my biggest macro concern. But otherwise, I am very optimistic. The numbers certainly are there. There's a lot of great companies with great fundamentals.
Yep. All right, guys. Well, look, let's do some final plugs here before we wrap up. And thank you guys. So maybe Chris, if you want to talk about, you mentioned your Substack and others, how they can sort of get in touch with you and follow your work.
Yeah, Substack is probably the best place. Put out a couple articles there and all sorts of weird, interesting information, especially about small caps. It's kind of hard to come by. So check that out for sure. Also have a Twitter, so out there, X, whatever people are calling it these days. And of course, our website right there, 1035capital.com. feel free to come check it out.
All right, David?
HortonFund.com. We don't produce a lot of public-facing content, but please be in touch via LinkedIn, or we'll get my contact information out there. Looking forward to seeing anybody at an investor conference coming up. And thanks for participating.
Absolutely. Barry?
So my firm is Litchfield Hills Research. Our website is hillsresearch.com, and our research is all available. You don't have to register. Just go to our website, hillsresearch.com, click on current research, and all of our reports are right there, free, no obligation. We don't track you. We won't get your email address. We won't come after you. All that research is available.
All right, fantastic. Well, gentlemen, thank you very much for the time today. Informative conversation. Hope from my standpoint, I think the audience certainly will as well. Look forward to connecting with you all again in the future. Hope you enjoy the conference here today, and we'll talk again soon.
Thanks, Rob.
Thank you.
Thanks.